of Bitcoin or the S&P, I think the conclusion generally is that like 80% of your returns come in like 1% of the days.
Yeah.
So if you look at the entire crypto universe, you have a lot of different creatures. You have crypto commodities, you have crypto securities, you have crypto exchanges, you have cryptocurrencies. And then you have a set of applications and protocols that interlace with all of these instruments. And what you have is a bunch of people in the ecosystem that don't necessarily understand or have the information to make the best decisions. And you have a lot of people outside of the ecosystem that are afraid to enter the ecosystem because they don't have the clarity they need. So for example, what's a currency? Well, a stable coin is a currency. In theory, if I can move $1 million from me to you without incurring a tax bill, that looks like a currency, a stable euro, a stable yen, a stable dollar. There's a huge amount of demand for it. It's probably $1 trillion to $5 trillion of demand for it. Everybody wants it. However, you have 3 different types of stable coins off the top of your head. You could have stable coins that are backed one for one with dollars, and they look fairly secure. You could have if you saw $10 billion of that stable coin with $10 billion of currency equivalents backing it, or cash equivalents backing it, then that's something that you probably could trust and put a lot of weight on. But one of them, like UST, collapsed to zero because it literally didn't have anything backing it, or maybe the backing was 5%. It might have been back 5 or 10%. I don't think they had $18 billion worth of cash equivalents, so they probably didn't have $18 billion of real estate or junk bonds backing when they got to 18 billion. They had $18 billion worth of Luna, right? And so what you have there was something highly risky, but not perceived as risky because there's not really clear disclosures. And if you'd asked 1,000 people, what's the difference between UST and Tether and Circle, they couldn't tell you. Right? But that would be the three examples, right? Sort of Tether's in the middle, Circle's on one extreme, UST's on the other side. So this crash is going to cause a lot of clarity to form there. First, the community is getting educated, right? I bet you everybody in the crypto community today knows the difference between a dollar in the bank and UST. And I bet you they have an intelligent conversation about the difference between Circle and UST and the business model of the two. And we saw last week, Tether had to redeem billions and billions of dollars of Tether. And they could, right? So they could. But if you'd actually tried to redeem $7 billion of UST in a couple of days, well, people tried to do that and they couldn't. Not everything is equal, right? There are 19,500 things, on coin market cap, but they're not all equal. So to say, well, this is risk-free or that is, like they all have different flavors of risk, but how do you assess the risk? So I think that the industry is getting more sophisticated. I think that the regulators now have some pressure. The Secretary of the Treasury was in a congressional hearing with Senator Toomey, and he's been an advocate of some stablecoin legislation. And he asked her, you think we need to get it done this year? And she said, yeah, I think we can and should get it done this year. So the consensus among the regulators and the politicians is, yeah, we probably need to do this. Now, you could say, if you're the crypto anarchist, I hate regulators, I don't want them to do anything. Well, that's one way to view it. But as long as they don't do anything, the industry stays $1 trillion, $1, $2, $3 trillion. When they do something, then you're going to see people like, let's say David Solomon was on CNBC last week. He's the CEO of Goldman Sachs. Well, whatever Goldman Sachs thinks is probably what JP Morgan thinks and Citigroup thinks and Bank of America thinks and Wells Fargo thinks. So what he says is, yeah, we know the crypto economy's here to stay. We can't custody it yet. You could either stay in a regulatory gray zone where there's about 1% of the money You can be 1 or 2% of what you're going to be, and you can stay in the gray zone. Or you can create a clear public policy framework, and then you move into this compliant zone. And when Goldman Sachs and JP Morgan enter the space, they'll issue $500 billion of stable coin, trillions of dollars. And so you'll go from 150 billion to 1.5 trillion. And when they start issuing in that size, you'll see Amazon and Google and Microsoft using stable coin for international remittance and corporate remittance. And then you'll see it get built into Apple Pay and Google Pay and Amazon as a payment method, right? And then you will actually see billions of people using this stuff. I think that the consensus is the regulators need to provide more clarity on this issue of stable coins, and they also need to provide more clarity on the requirements for a crypto security. It's clear that Luna was a crypto security. The reason it's a security is there's an issuer and there's someone that can make decisions. And if I can actually make decisions, if I can take $3 billion and buy Bitcoin, and then I can take the same Bitcoin and sell it on behalf of the people that own the Luna token or on behalf of the people that own the UST token, I'm acting, kind of like a public company officer, and if you're a public company, think about MicroStrategy. Like if I just sold all of MicroStrategy's Bitcoin and I didn't tell you, right? Or if I bought twice as much and I didn't tell you, I would be changing the nature of the security. I have, kind of an obligation to disclose that, an ethical obligation as well as a legal obligation to disclose what I'm doing when I can actually impact the value of the securities held by the public. It'll accelerate the regulation of the crypto securities, and many of them are unregistered securities and there's no disclosure. It'll accelerate the regulation of the exchanges. It'll accelerate the regulation of the stable coin. And in the near term, there'll be a shakeout. So, some things, when you look at them in the light of day, you'll say, for example, what's a shakeout? I decide I like Circle better than I like UST. That's a shakeout, right? Right? And it'll also create an on-ramp for institutional intervention, because you've got $300 trillion worth of money, that's $100 trillion of bonds, $100 trillion of equities, $90 trillion of currency derivatives, all sorts of forms of money. You've got other sorts of derivatives. Goldman Sachs, JP Morgan, Citigroup, Bank of America, Wells Fargo, Citadel, all of Wall Street. It'll open the way for them to make markets, do research, right? And to provide liquidity. And provide liquidity eventually means loans as well as hold on their balance sheets.
Right.
And they're not going to do it as long as they don't know the difference between a commodity and a security, and they don't actually understand the legal status of these things. So ultimately, what you've got is a $1 trillion industry that'll become a $10 trillion industry if we have regulatory clarity, and then it will become a 20, and then a 30. There's no reason it can't go from $1 trillion to $100 trillion. But you've got to work through these issues. In fact, Jeff Bezos could have sold Amazon 5 different times and avoided an 80% loss. And if he'd sold at any one of those 5 times, he wouldn't be one of the richest people in the world. So I think that trying to time the market is a trader mentality. But if you look at all the richest people in the world, they're not traders, right?
They're heartless.
Bill Gates, Steve Ballmer, Jeff Bezos, Elon Musk, Mark Zuckerberg, right? Larry Page, name the person that traded their way to that situation. You can't really do it. Like, trying to time the market is ridiculous. If you look at statistical analysis of Bitcoin or the S&P, I think the conclusion generally is that like 80% of your returns come in like 1% of the days.
Yeah.
So if you miss the top 3 days of a year, you might lose 80% of your return. If you miss the top 6 days, you lose it all. It's going to look like you're not making a lot of money 98% of the time. And then you're going to wake up one day and you're going to find out that the sovereign wealth fund of some Middle Eastern country just bought $10 billion of Bitcoin. It's going to double or it's going to triple. And then you're going to be kicking yourself and screaming, saying, oh, well, I could have bought it at blank and I didn't buy it at blank. And you'll be angry. I think that the trading mentality is just really an awful mentality for anyone that, if you're not running proprietary algorithms on high-speed computers, like I get it if you're a high-speed computer trader and you're like slicing 1/10 of a penny 1 billion times an hour. Like I get that kind of trading, but for 98% of the population, people don't have any proprietary edge to trade. And so generally they all get beat by the market trading. What's beating inflation? Bitcoin is. What's losing? The traders are all losing, right? And most of the other assets are lagging. And everybody's thinking that they can time the market. But as a practical matter, I think they do a statistic and like 95% of active traders underperform the market. So MicroStrategy's got a strategy, right? Which is we're buying Cyber Manhattan. We're buying up, Howard Hughes went to Vegas and he looked around and he thought, this is a good idea, city in the desert. I'm going to buy it all. But he didn't buy the buildings and he didn't set up the casinos. He bought all the land. Okay. And he bought the idea is you buy the land underlying the city, and municipalities like Summerlin, they're built on top of his land. They're still building things on top of the land that Howard Hughes bought long time ago. Just like it's not a bad idea to own Manhattan. The trading, it's a different business, right? And I just don't think it's a good idea for most people. But regardless of that, if MicroStrategy was trading, we would just be a public hedge fund. There are thousands and thousands of public companies. People want to invest in something that they understand, that they can trust. So if you're going to be a theme park company, that's what you should do. If you're going to be a movie company, if you're going to be an oil company, you should be a pure play and you should focus, in a laser-like way on that, because that allows a rational investor to put you in their portfolio. For example, like maybe you hate Bitcoin. If MicroStrategy has a strategy, which is we're long Bitcoin, we're levered long Bitcoin, well, then that's good, right? Because now you can short us. It's not a bad thing for people to short your stock, because if they short your stock, eventually they're going to have to cover, right there. On the other hand, maybe they like Bitcoin, but they think it's 99% likely to fail. Think about it. You have $100 million, so you put 1% of your portfolio in it, and you want to find someone that actually is pure long Bitcoin, you see? So if we're transparent and predictable, then we allow a rational investor to allocate their portfolio rationally. And they just don't.
That's it for today, guys. If you found this video useful, then don't forget to like the video and share this knowledge with your friends and family. And don't forget to check out the full video, link is in the description. Thank you.